Good morning. Now, hey, let's do that again. One more time. Good morning. You know, I got to tell you, I've had a chance to talk to many of you when we're here, and so is Tim, and so is Adam and Emily. It is just a complete thrill to be down here, to be back again. And, I was thinking about why we come and why we did this. It's all about giving you three things. Number one is a big thank you. I'm so excited because many of you started with us in retirement feasibility, looking at can you retire, many from the Boeing Company. And we now have clients, as you may know, in 30 states. The biggest contingent, of course, is in the Pacific Northwest. Second one is right here in the Phoenix area, in Arizona. So we are thrilled to be here, and this is the largest group, of course, outside of Washington. Last time we were here was in 2018. So how many of you were here in 2018 by show of hands? Wow. Thank you very much. And some of you have said, I won't name names, some of you said, hey, when are you coming back? We want you to come back. And so we're excited to be back. And this was planned, I think, 7 months ago with our speaker and with the venue and all that. So we're thrilled to be back. Well, about time to introduce our speaker. So we're going to bring up Tim Kimmel. He's going to introduce our speaker and a few more comments as well. Thanks, Tim.
Thank you, Paul. Thank you. Thank you, Paul. I appreciate that. And but with that, again, I have the privilege of introducing our speaker. And I'm going to read this just so I get it right, Michael. Michael J. Collins is a managing director and executive portfolio manager on a multi-sector team at PGIM Fixed Income. Mr. Collins began his career at PGIM Investments in 1986 as a software applications designer. He received his BS in mathematics and computer science from Binghamton University and an MBA in finance from New York University. Mr. Collins holds a CFA, Charter Financial Analyst designation, and is a fellow in the Line of Management Institute. He currently serves as a vice chair on the board of CEA, a nonprofit that provides education and employment for people with disabilities. So, impressive. Mr. Collins was named the 2019 winner of the Pension and Investment Provider Award for Global Multi-Asset Credit. He regularly speaks with financial advisors and platforms like this on a national level, and does kind of focus on PGIM's global outlook as far as market outlook. So he has a lot of good things to bring. He also talks about, as Paul mentioned, the geopolitical issues, Fed policy, interest rates. So he's got a lot of good information to bring. Another thing, too, just on a side note, is that he was one of the lead managers for many of you that do work at the Boeing Company or had worked at the Boeing Company. I know a lot of you are retired. Remember the Boeing VIP, right? The Boeing Retirement 401k plan had a fund called the Stable Value Fund. Remember that? And he was one of the lead managers that managed a tranche of that Stable Value Fund. So again, with that, I have the distinct pleasure of introducing Michael J. Collins. Please welcome him.
Thank you. Thank you very much, Tim. You all can hear me okay? Is that on? All right, thank you. I am so honored, Tim and Paul and Adam and Emily, to invite me here today to talk to you. As Tim mentioned, I manage money for the largest governments and financial institutions in the world. A lot of them are giant overseas sovereign wealth funds. 3 of my clients, my team manages $30 billion for. 3 separate clients. One is a sovereign wealth fund in Asia, one is a labor union in the United States, and another is a big financial services firm in the United States. So those are just 3, right? So, I talk to these giant institutional investors all the time, all day long, all over the world, to really get a sense of what they're thinking, where the money is flowing. Boeing, I was surprised. I was telling Paul, who here is involved in Boeing? Everybody in the room, right? I have met with Boeing dozens of times over my career. We still manage a huge percentage of that Stable Value Fund. I go to Chicago, so your finance team is at you. Boeing's finance team is still in Chicago. I've been meeting with them for decades, and Boeing's one of our longest standing clients in our organization. And we manage about $2.5 billion just for Boeing in the stable value. So thank you for the business. But you are like what I call real people, right? I mean, you're like real people, like investing your own money, and you're here, you know, and giving money to Paul and his firm, you know, to make sure you have financial security and stability in retirement, right? That is like so important. We are all doing God's work in this industry, right? I mean, I have a son, he's in India right now, he's meditating, he's doing yoga, and he did this big analysis on our whole family based on our birthday, where we were born, you know, the day we were born, the time of day, and he's like, Daddy, you're the most empathetic, sensitive person I've ever met. He goes, you could have been a principal of a school, you could have been a guidance counselor, you could have been in social work. I'm like, what are you, demoting me? I mean, why are you trying to give me these lousy jobs? He goes, they are not lousy jobs, Dad. They're helping people. And I've been telling him for 40 years, which is when I started almost 40 years ago, we are helping people. That's what we do in our industry. I'm helping people every day. My goal, our mission as financial advisors and investment managers, to make sure you all real people, you know, like I manage money for Boeing. Oh, it's a big institution. Who are the constituents? It's you, right? And it's your children and family members. The labor union. These are UPS truck drivers and dock workers we manage $30 billion for, right? And their end clients, whether it's a giant institutional fund, are all people, right? And they're workers, and a lot of them are blue-collar workers, believe it or not, right? And teachers, and we manage money for, you know, the state of Arkansas, the state of Mississippi, the state of Florida, the state of New Jersey, you know, the state of California. And the investors, the constituents, are public workers, right? So, I mean, we're all in it to make sure that you're happy and healthy, and I know Paul and his team are doing a great job. I've worked with them for many years on their asset allocation for you, and I know you have this fixed income, you know, foundation or bond foundation in your portfolio, and that's really my expertise, and I'm going to talk a little bit about that today. But you also have your growth component to it, right? And the balance is really good, and what they're doing for you is the right thing, right? And that's really what you should take away from this. And they welcome me here to give you a little inside baseball on kind of what's happening underneath the covers, what's going on in the world, what's going on in the markets. I will talk a little about bonds. You know, I'm a bond guy. I was a math major, so there will be a test afterwards. We're going to do a lot of detailed bond math in this session. So I hope your stomachs don't get upset after that great lunch. But seriously, I will talk a little bit about politics, right? And I want to leave plenty of time to answer questions at the end. So let me kind of rifle through some of these slides. I know you have them in there, and they're really tough to read, and a lot of them are pretty geeky, right? Because that's what we do in our business. But I want to give you the high-level view of really what's happening in the world. And the summary is that things are actually okay. I was really fascinated by the survey. Who thinks the markets are going up? You know, about a third of you. Who thinks they're going to be stable? A third of you. And who thinks they're going down? A third of you. It's like, well, that's what makes markets, right? As my dad used to say, that's what makes horse races. And there is a lot of uncertainty, right? And one thing I hear all the time is like, oh my God, we're going through this unprecedented period of uncertainty right now. We have no idea what's going to happen on the policy front. We have this government that's changing things, you know. There's all this volatility out there. I'm like, no, there's not. This is actually a really stable environment. I mean, our U.S. economy has been growing at like 2.5 or 3% for years now, following the big downturn and rebound in the pandemic. Inflation has come down. It's pretty stable right now, around 2.5. Interest rates have kind of been stable. Stocks are going up a little bit all the time. It's like, this is not uncertainty. Uncertainty was the pandemic. Right? Uncertainty was the global financial crisis. I've lived through way too many crises in my career to name and count, and this is not one of those periods, right? So take some solace. And I have a lot. You know, I'm from New Jersey. I have a lot of friends and family. You can imagine they're like up in arms about the Trump thing. I'm like, guys, it doesn't really matter. No president is going to really change your life, what you're going to do on any given day, you know, unless you're one of the people he's laying off or whatever. But by and large, us as Americans, we are all have the same convictions, there's a lot of the same ideals, the same goals. We care about our family, our jobs, our livelihoods, our health, our kids, and we're all in it together. And the president does not change anything. You look at historically, whether it's a Democrat, a Republican, you know, a mixed Congress, whatever, the returns in the market and the economic results are almost identical across hundreds of years of different regimes, right? And it doesn't really matter that much. So take that with a grain of salt. We do have checks and balances. I actually met Trump, probably 25 years ago. He came into my office, right, and he was looking to borrow money. This was before any political aspirations before The Apprentice. He was kind of a well-known, real estate guy, a casino guy, and I was the casino analyst at the time. He came into our office and he wanted to borrow $300 million to build a casino in Atlantic City. And he was offering 13% interest at the time, right? And, first of all, on his way in, he's flying, he goes, hey, this is the Donald, how do I get to Newark? Newark, New Jersey is my headquarters. That's where our giant trade room is with 250 traders. How do I get to Newark? I go, well, you take Route 20. He's like, no, I'm in my helicopter. I go, Donald, I know how to get here from the PATH train. I know how to get here. I don't know how to get here from a helicopter. I would think you would have that figured out, once you get in the helicopter. But anyway, he gets in, and we didn't give him the loan, right? For a lot of reasons. One, it was a construction loan, so it was very risky. He hadn't built this thing. Secondly, it was in Atlantic City. I don't know if any of you have ever been to Atlantic City, New Jersey. It is a dump, right? I mean, there's some really nice casinos, but once you get out of don't leave the casinos, right? And he wanted to build it in a new area, this marina district where there were no casinos. It was a swamp, and he wanted to build a casino. And I'm like, all this sounds great. And the last time we lent you money, you didn't pay us back, right? So get the loan. He got the loan from someone else. It all worked out. But that's not a political statement. That's who he is, right? He is a debt guy. But the thing I take solace in, he was a Democrat back then when he came into our office, right? He was a Democrat 15 years ago, right? He sounds like he's super dogmatic and super focused on these particular policies because he has all these people talking to him about it, but he will change gears, right? He will shift policies. I mean, the things he cares about are his popularity rating, the Dow, the inflation rate, the price of gas, and if those things start moving in the wrong direction, he will shift gears, man. He will change the tariff policy. He will change the trade policy, the tax policy. And so that kind of gives me comfort, right? And I talk to people who are worried about it. Last time he was president, we had a pretty good 4-year run. The economy actually did okay. Then we had the damn pandemic, which wasn't his fault. And we had a pretty constructive response to it. We flooded the system with money. Nobody lost their jobs. Nobody went bankrupt. We survived it. And these next 4 years probably will be okay too, right? So that's kind of my policy thing. But the outlook is actually fairly stable. We actually expect growth. So this is a chart of just like GDP estimates. So this is the growth rate of the world, of the US, of Europe, of Japan, of the UK, of China, right? And what you're seeing here is like a moderation in growth from 3 to 2.5 to 2 to just below 2 over the next 3 or 4 years. That is our best guess. But to be honest with you, I have no idea what's going to happen, right? Our economists have no idea. The Federal Reserve is terrible at predicting the path of the economy, right? The path of the economy, again, is not really based on policy. It's based on all the decisions of like billions of people all around the world. And if they freak out, they stop spending money. If there's uncertainty, they stop investing, right? If they're really happy and optimistic, which is what's happening now, they invest more, right? And you get these kind of bubbles and busts. And right now, it feels like we're kind of in a high, I don't want to call it a euphoric stage of the cycle, but we're in a pretty, risk-on stage of the cycle, right? I'm a little worried about that. I always think of the world like in this fear and greed pendulum, right? And I'm a big behavioral finance guy, meaning us as humans, we're terrible investors, right? We really are. That's why we hire people like Paul and his team, because we shoot ourselves in the foot all the time, right? When everything's going great and our friends are making money, we're like, hey, let's do that. Let's buy more Bitcoin. It's going up every day. Let's buy NVIDIA, and we all do the same thing because we love the comfort of doing what other people are doing. They call it herd mentality or lemming-like behavior. And then we're also trained as, again, Homo sapiens to run from danger, right? Get the hell away. And so when things go bad, like a pandemic, people panic and sell everything, right? And our job in this industry is to stop you from doing the things that you're innately geared and trained to do. So behavioral finance is important. So these cycles move, and recessions happen all the time, and nobody predicts them, right? I mean, one of my favorite things to do is we get 30 of us in our trading room, and the 30 smartest people, and we get it there in a room, and we put a whiteboard up every quarter. We say, what are the 10 things that are going to blow up the economy? Like, what are the things that can go wrong? And we list them all, China, geopolitics, inflation, the Fed, tariffs, you put them all on the board, and we look at it, we say, all right, it's not going to be one of those. You know, that's one thing we know. What is the 11th thing? Like, we didn't call it the pandemic. We didn't call it the great financial crisis. We didn't even call the regional bank crisis 2 years ago. We didn't call the European fiscal crisis. We didn't call, you know, those things were not on the board, right? And that's what happens. And so you have to be really, I mean, this is a very humbling business in investing, right? Because you really have no idea what's going to happen. So we guess that, yeah, based on what we know, the economy is going to slow down a little bit, but this is actually a really good outcome. Right? That means things just moderate. We don't overheat, which is when you get the busts, when you kind of overbuild, overexpand, overborrow, and we haven't had that cycle, right? Like, people are shocked. Like, what happened? The Fed raised rates 500 basis points from 0 to 5.5, and nothing blew up. Yeah, a couple of regional banks went under, but it's like we really haven't had a problem. Like, why is that? Every other time the Fed raised rates 5%, things blew up. It's like, yeah, because normally the Fed's raising rates after a long expansion. Right? After companies have built a lot, they've hired a lot, they've overexpanded, overborrowed, you have all these leveraged buyouts, and you have these big bubbles, and then they raise rates, and this house of cards comes crumbling down. This cycle, we haven't built a house of cards, right? The private sector, whether it's banks, mortgages in general, consumers in general, companies in general, the private sector have not levered up. They have not overexpanded, overbuilt, and overborrowed. Maybe there's too many apartment buildings. That's a little bit of a bubble, but that's going to be digested. But other than that, you really don't see the excesses, which is really good. And that's why rates went up, and it's like nothing really happened. All of the leverage this cycle, all of the debt went into the government balance sheets, the Treasury, the Chinese government, the Brazilian government, the French government, the Italian government, the Japanese government, every government, and we're not alone, every government in the world took all the money they had, they borrowed more money, they issued more bonds, and they gave it to their people and their companies so they kept their jobs during the pandemic. And now they're sitting on all the debt, right? So when the Fed raises rates, the government is kind of a little bit of a cushion, right? They can absorb it temporarily. The private sector has kind of got off this cycle scot-free. So we actually think things are actually pretty good. Right? So don't panic. If you think we're going into a recession, maybe you have a crystal ball that I don't, right? Maybe something bad is lurking, but I have a tough time seeing it right now. So what we do, so we know this is going to be wrong, right? We have no idea what's actually going to happen. We're guessing. These are we call these point estimates, what we think is probably going to happen, but we have no idea. So what we do is put these different scenarios, right? So, okay, what could happen? Like, what is the range of different things that could happen, right? So we have this thing called a soft landing. We have a 55% probability. That's what you would call a base case, right? That's like the most likely thing. And all that is what I just talked about. Like, growth slows down a little bit. Inflation comes down and doesn't go back up a lot. The Federal Reserve, after raising rates a lot, can start cutting rates again a little bit. Interest rates stay where they are. They come down a little bit. You don't have a lot of defaults. That's a really good environment for all of you. It's good for jobs. It's good for your house price. It's good for your assets, right? Because that's a really rosy outcome. The other ones aren't so great, right? So these are what we call the tails. Like, what could go wrong? 55% is not 100%, right? It's not 80. It's not even 60. Like, I wouldn't say these are fat tails, but shit, stuff happens, you know? And so recessions happen, you know? So you get 15% probability of recession, which is actually low, right? Historically, like every 8 years there's a recession, so that's 12.5%. Right? So we're kind of like a normal recession risk, just because, again, things happen that we don't expect, and you always have to think, hey, there's some reasonable probability that something at the end of the year kind of blows up. It could be climate, it could be geopolitics, it could be policy, it could be the Fed screwing up, it could be, you know, I don't know, a war. I mean, who knows, but things happen. It could be another pandemic. So that's like the downside, and then you have this upside, right? We call it the roaring 20s or the nominal GDP boom, 25% chance. So this is kind of similar to what the survey we just did in the room, right? There's like a 25% chance that things actually keep doing better, right? And that's, you know, the AI or productivity just keeps going up, and equity earnings, even though the expectations are really high for corporate earnings right now. Like, the end of this year, street analysts assume like earnings go up 14%. Third quarter, fourth quarter, and I'm like, I don't know. I don't see how that's happening, but it could, right? And if that happens, you kind of continuation of strong growth, that instead of the thing coming down, that growth kind of stays at 3%, for the next few years, and inflation doesn't come down to 2, it stays at 2.5 or 3, and the Federal Reserve doesn't cut rates. Rates stay where they are, or maybe they even hike, right? Which I don't think is going to happen, but it could. I didn't think they were going to hike 550 basis points, and they did, right? So who knows? So that's the nominal GDP boom, and it all sounds great, but it's not so great, right, for financial assets. I mean, it's kind of okay for equities, but ultimately, I think it just means there's kind of, that's when the animal spirits really take hold, and that's when the leverage starts building in the system, and you're just at the point in the cycle now, and I'm a big student of economic cycles, of the credit cycle, and normally, you know, you have all these defaults, companies, you know, blow up, they repair their balance sheet, they cut debt, they stop spending, they stop hiring, and then you get to a bottom of the cycle, everything's stable, and then they say, hey, everything's kind of okay. Let's start hiring more people. Let's start building more factories. Let's start borrowing more money. Let's start levering up again, and let's try to juice our equity returns. And it feels like you're kind of in that transition stage here. You're actually in the sweet spot right now, but I'm seeing more and more examples. And again, like Trump, like reinvigorating these animal spirits and talking about corporate tax cuts, additional tax cuts, about deregulation, you know, could kind of unleash more of that speculative behavior. And so I worry, like when I see the stock market going up a lot, that makes me nervous, right? And I just think, hey, everybody's kind of piling in here, right? Maybe we're starting to get to that point in the cycle where you have to worry about a bubble forming. But right now, we don't have that. I mean, maybe the NASDAQ goes down 30% one day, and who knows? I don't think that's a big deal because it happens all the time. As Paul said, it just happened a couple of years ago, right? That's like normal. So that could always happen, and you know, maybe NVIDIA has to go down 50%. Who knows? Maybe AI is just overpriced, which I kind of think, but who knows, right? So this could happen. The good news is, I don't think it's that likely to like surge from here because it just happened, right? If you look at nominal GDP, so you know what nominal GDP is, right? It's like the value of everything we produce and buy in this country at today's dollars. That's nominal GDP, right? So nominal GDP in the U.S. is close to 30 trillion. It was 20 trillion in the bottom of the pandemic. So nominal GDP in this country has gone up like 45% in just over 4 years. That is the biggest increase in the value of everything that we produce in this country since just after World War II. So we have just gone through a post-war-like, a post-pandemic boom. We've had the nominal GDP boom, right? In fact, if you look at the debt of our country, which everybody's worried about, and I'll talk about it, it's really high, it's really high, it's really high. But the way you look at debt, debt is nominal, right? It's based on tax receipts, it's based on nominal earnings, nominal growth, and you look at debt relative to the size of the economy, believe it or not, since the pandemic, it's come down. Even though the debt's going up, the economy has grown faster. Right? So it's like, wow, maybe it's not so bad. As long as the economy keeps growing, it's okay. So we just had this huge boom in nominal GDP, and I'm going to take the under. I don't think that's going to happen. I don't think a recession's going to happen. I won't even talk about stagflation. That's a disaster for everybody. But you know, I just think we're kind of in a fairly stable spot here. Let me talk about inflation, all right? Inflation's been the bugaboo. Inflation is really why Trump won. I mean, if it wasn't for the inflation, I don't know if he would have won, right? And this is what he campaigned on. This is why he has to make sure he kind of has it in control and gets inflation down. And you look at this, right? This is just consumer price index. This is headline inflation. All we did here is strip out shelter or housing. And the only reason we did this is because the way housing is calculated into inflation, it's a real lagging indicator. Like right now, housing is contributing like 6% to annual inflation. And I'm like, but wait, house prices, just looked in my region in Florida, house prices are down year over year. You know, we just had, you know, house prices are so high, rents went up so much during COVID. Rents are actually not going up, they're actually going down on average in this country. And I'm like, so the inflation right now on housing is kind of zero. But it's showing up at 6%, right? So if you just strip out that, because I don't think it's calculated that great, it lags. So you strip that out. Look where inflation is today. Whether you include food and energy or you don't. Where they just take it, all I'm doing is just taking out housing, and it's at 2%, right? Headline, core, 2%. It's like, it's not 3, it's not 4, it's not 8, 9, it's 2, which is the Fed's target, right? It's not high, and remember the Fed got blasted for using this transitory word. It's, oh, inflation is transitory, and they're like, no, it's not, look at it. But you look at his charts, like, wow, it kind of looked like it was transitory, right? It's just that, you know, they called it transitory back here, It's like, oh no, it just keeps going up. And then they call it transitory, oh no, it keeps going up. And so it was like a long, 2-3 year period, but it's back down again, right? The rate of change. Remember, inflation is the change in the price. So you all feel it, and I feel it when you go to buy eggs and all this other stuff. Like, it feels like prices of everything, whether it's rents or houses or insurance, are really high, right? And if the prices just stay at these levels, really high levels, unaffordable levels, for 5 years, you know what happens to inflation, right? Zero. It goes to zero, right? And that's why it's at 2 now, because prices went up so much on everything that they're just not going up a lot more. They're just kind of staying at these high levels. So the price level is really painful for a lot of people. I mean, I have 3 kids in their 20s, and they're like, Daddy, how do people afford to live in this country? Like, they all work their asses off, and they can't afford rent and insurance and their car and food, and God forbid they go out or take a vacation. They can't afford it, right? And they're working, and it's really tough. One worked at Nordstrom in Seattle, actually, in the headquarters there, and now she works for Dillard. She's a buyer. She just got a big raise. She's making $50 grand. And you cannot afford to live in this country on that as a single person. It's terrible. And she's on my insurance still. Wait till she has to pay health insurance, right? Hopefully Dillard's takes care of that. But so inflation has kind of come down. If you look at the components of inflation, this is really interesting, right? So you look at like goods, like discretionary stuff, the stuff you don't have to buy, vacations, that Peloton you all bought, during the pandemic, and like that kind of stuff. So goods inflation was always like zero for most of the last decade, and then it spiked, because remember, there was a shortage. We couldn't make the stuff, and everybody was stuck home, so like, let's buy goods. We can't go on vacation. So the goods inflation went up to 11, and then it went negative again. So it's really kind of bouncing around zero. It's ticked up a little bit, but it's bouncing around zero here. But look at the other components. This is the housing part, right? Again, housing year over year was going up at 8%. Because it jumped during the pandemic, and now that rate of change is really coming down, and it's still at 5. I think it's going to go down to here, to 2 or 3. This yellow line is Staples, ex-house, so it's everything else. It's like the food you have to buy, the gas you have to buy, all the stuff you have to buy, healthcare, insurance, and that really jumped, and it's starting to come down again. I mean, if this thing bounces around zero, and these two keep coming down, I mean, that 2% is going to kind of stay where it is, right? It's not going to go back up. So everybody kind of feels, I think, the food thing and some of the components and maybe this thing, but on average, there's a lot of things offsetting each other out there, right? So again, I'm not like panicked. I'm not in this like hawkish inflation camp. Oh my God, it's reaccelerating. I mean, it kind of looks like here it's ticking up a little bit again, but I don't know. Who knows? I think if it just stays in this range where it's been for a year and a half, I mean, that's a really good situation, right? That's a world where the Fed will be able to cut rates. Let's talk about, I told you about this. This is rents. Year over year in the country, rents are down 0.5%. We had a big bubble in apartment building construction. That's coming down. Vacancy rates are going up in apartments because they built too many of them. I know I'm in Florida, man. Every piece of land they can find are building these apartments. I'm like, who's going to live in these places? Who can afford it? And they're going to have some empty apartments. So you're starting to see that happen. But that's just a little transition. If you look at wages, right? So wages are the yellow line. Wages were growing at over 5% year over year a couple of years ago when we couldn't find people, right, to fill all the jobs. And now it's growing at just under 4%, like 3.9%. But look at this black line. This is the best leading indicator for wage growth, meaning the increases people get on average each year. This is what they call the quits rate, right? This is one of those weird little leading indicators that economists look at to try to figure out what's really happening in the jobs market. Because on the headline, the jobs market looks really good. I mean, I'm the guy on Bloomberg TV the first Friday of every month when the Bureau of Labor Statistics puts out the jobs number, like, oh, we just added 250,000 jobs to the economy. I'm the guy they call, and I get on TV the first Friday of the month, which will be in a couple Fridays from now, and talk about what's going on with the jobs market, and it's like unequivocally strong all the time. But if you look at the lead, and the labor market's a lagging indicator. Like, the last thing you do as a company is fire everybody, right? You cut their hours a little bit, you stop using temporary workers, you cut your marketing budget, maybe you cut a little spending, maybe you stop giving raises, and then you fire. By the time you're firing people, you're in the recession. right? So don't look at the labor market as a leading indicator, but this quits rate is. This is what, people who are quitting their job to get another job. When the labor market is hot, they all quit and they get a big raise when they go to another job, when you switch jobs, right? I've been at PGIM for 40 years. You guys probably spent a lot of your careers at Boeing, so we're not the quitters, right? We stayed in our jobs. We gave up getting raises by jumping around to jobs for the stability. But if less people are quitting, it means they don't think they can get a better job. They're worried about keeping their job, and that's a great leading indicator for wages. So maybe that's going down. This, I think, is where the markets are mispriced. Right? A job of investment people is to figure out what's priced in the market, those probabilities that are priced in, and what the market's getting wrong. Right? I mean, I believe that the markets are efficient, but man, they are based on human behavior. And again, as humans, we are terrible investors. And we create these bubbles and busts, and we overshoot all the time. And my job, and our job in this industry, is to find those mispricings, the things where everybody's like, wow, that doesn't seem to make, I think it doesn't make sense, like what the markets are thinking right now, writ large. So this is what's going on. So these red dots, this is a little inside baseball. These red dots are the Federal Reserve. So remember, the Federal Reserve went from a 0 interest rate on your money markets to a 5.5, right? And then they cut it 1%. So right now we're down here around 4.5. The red dots are if you interview the Fed at their quarterly meetings and you say, hey, where do you think the federal funds rate, that money market rate, is going to be over the next 2, 3, 4 years? This is what they think. They think it's going to go down a little bit this year, a little bit next year, a little bit, and end up at like a 3%. The light blue line is the market's best guess of where this really important short-term interest rate is going to be. Meaning the markets are saying, you're not going to cut rates. You're full of it. The economy's too strong. Inflation's too high. There's too much uncertainty with this policy. Like, why would you ever cut rates, right? And I think that's true right now. Like, right now, the Federal Reserve is in a corner. They're on ice, man. They are not going to do anything. There's no reason for them to. The markets are doing great. The economy's doing great. The labor market's strong. Why would they change anything, right? So they're going to just keep the rate right where it is until something changes. The question is it going to change on the upside or the downside? Will they hike or will they cut, right? And I'm totally in the camp that they're going to have to cut at some point. But the markets are not there. The markets are saying, you know what? I'm going to take this current environment we're in, and this is the behavioral finance rule of recency bias, right? Meaning, in individuals, we have a really tough time thinking of a different paradigm other than the one we're in today. During COVID, everybody thought like the world was coming to an end. It's like, no, it all came back. And now everybody's like, wow, this is great. Everything's going to stay great forever. It's like, that's not how the world works, right? And so the markets are assuming this really strong growth pattern continues in the U.S., that we don't have a slowdown in growth, that inflation not only stays where it is, maybe it ticks up a little bit, and that the Fed will not only not cut rates this year, but won't cut rates again. And this actually, believe it or not, the markets, you can look out 10, 20 years on what the markets are pricing in terms of that federal funds rate, that important money market rate. It's 4% forever, right? So the markets are basically saying the Fed is going to cut one more 25 basis point rate cut and never cut again for the rest of our lives. That's what's priced in. I'm like, wow, I'll take the under, right? And so that's what I think's going wrong. So you have 10-year interest rates are really, really high. I think interest rates in the U.S. are really, really high. So you look at what's priced in terms of probability. So the markets right now, and this we use options and all kinds of like detailed market analysis to figure out the actual distribution of the scenarios that are priced in. This black line is like interest rates, the funds rate being between 4 and 8, and the probability of that is like almost 2/3. The probability of it ever going below 2.5 again, where it spent most of the last 15 years, is almost 0, right? So this to me, and you see this is like mean reverting, right? The markets get really excited, oh shit, the world's coming to an end. Then they get really excited, and I think this stuff is mean reverting. Because again, markets are based on human behavior, and we're bad at this stuff. So we get over our skis. So I'm looking at this going, I don't believe either of these numbers. I think the truth is somewhere in the middle, and the markets don't appreciate that, right? So I'm adding interest rate risk. Your team has a decent amount of bonds in your portfolio, or the foundation of your portfolio is probably larger than a lot of other shops, right? So you don't have to worry about getting over your skis, and NVIDIA and this stuff. They're doing such a great job making sure you have that ballast, that foundation, and that's my job. And they're also one of my big clients, right? I actually manage part of your fixed income, your bond, your foundation portfolio. So thank you for that. And we do it in a very conservative way. We're really good at it, and we're not going to blow you up, right? That's our job, to be that foundation. But I think the markets are a little screwed up. So look at interest rates here, right? Again, this is what the Fed thinks rates should be, somewhere between 2.5 and 4, and they're really high, right? That's why, Trump is like, guys, you got to cut rates. Right, and he knows he's a debt guy. He's the guy who wanted to borrow $300 million from me and wasn't going to pay it back. But he wants rates to be lower. He knows the Treasury has too much debt. He knows we can't afford to keep paying these high rates, right? And then he said, I'm not going to jawbone the Fed. I'm not going to, beat up Powell. We're going to do a truce. I'm going to send my new Treasury guy, Scott Bessent, who used to manage hedge funds. He's like an investor. I'm going to get him to jawbone rates down. So Bessent comes out last week, goes, don't worry about the funds rate. It's that 10-year rate is too high. We got to get that damn thing down, So here it is at 4.55 today, 4.5% on the 10-year. And Trump thinks it's too high. Bessent thinks it's too high. Jerome Powell, the head of the central bank, thinks it's too high. I think it's too high, right? But the markets thinks it's perfectly fair value right now, forever. So just to give you a sense what's going on. We'll skip the real rate thing. This is the deficit part, right? This is like the debt thing that everybody's worried about. If I get one question every single meeting I have, it's like, what are we doing about all this debt, right? What the hell is going to happen? It's going to blow us up, right? And the answer is like the debt isn't the problem. What's the problem is this light blue part over here. This is the interest on the debt. Right? Like I said, the debt to GDP has actually been coming down because the GDP part, the economy, has been growing so fast that we do not have a debt problem in this country. We have a supply problem. We issue so many treasuries. Like we did $125 billion of treasury bond auctions last week. And they didn't go so great, right? That's 0.5% of GDP, just in 1 week. We're doing 20-year treasuries today, like $16 billion. And it didn't go that great. They just issued them a few minutes ago. It's like, there's a lot of debt, man. Somebody's got to buy this stuff, and who's going to buy it? But that's really not the problem. The problem is when you take all that debt times the interest rate, right? That's your average interest expense, right? And you all know with mortgage rates at 7, you're like, I'm not taking out a mortgage. There's no way. People who have a 2 3/4 mortgage like I do will never rip that thing up, right? That's worth tons of money if you do present value on it. But man, you'd like the government debt times the interest rate, and this is the interest expense as a percent of the economy. It is going straight up. And what that means is at some point the government, the Treasury, will be paying so much of their tax revenues to servicing the debt, to paying interest. And who does the interest go to? It goes to the Chinese, the Japanese, you guys, because you own a lot of bonds, thanks to your advisors. Me, I'm way overweight in bonds. I mean, these guys would think I'm crazy if they looked at my portfolio. I'm a bond guy, and I'm like 80-20, bonds versus stocks, foundation versus growth, because I know all the bonds, and I know the people who are managing them, and I know the yields are really, really high, and I like having that stability. The income that's pouring into my portfolios every day, my personal portfolios, is so big. I'm like, I don't deserve this money. Like tens of thousands a month are coming in. I'm like, no wonder we have a wealth effect in this country. No wonder every steakhouse in this country is packed on Tuesday nights. It's because the top 10% of the economy, people like you and people in the investment industry, and are doing great because you own houses, you own stocks, and you own bonds, and you're generating all this income and all this wealth. But the other 80%, and half of them are my siblings, and all 3 of them are my kids, they are struggling, man, and I worry about that other 80% that like the markets are kind of whistling past the graveyard, as they say, and like saying, well, they're going to be fine, don't worry about them, But the student loans are kicking in, the interest rates on their debt are kicking in, the amount of debt they're incurring is increasing every day, right? I mean, it's really, you're starting to see a problem emerge in that part. And it's not like the bottom 10, man, it's like the bottom 80. It's like a huge percentage of this economy, and it's the U.S. government. They can't afford to keep paying this interest, because once they do, if they pay more in interest, then it's less they can allocate to the economy, to the private sector, and you have a recession, right? I mean, thing that's a rule of thumb, when you have a lot of debt at a government, it slows growth. It doesn't add to growth. It adds to growth in the near term, yeah, because you borrow all this money, you have a big party and it feels great, but ultimately someone's got to pay it back. And governments default all the time. I've seen probably hundreds of governments default in my day, from Brazil to Russia to Greece, and over and over and over. It happens all the time. They just borrow too much money. We're not going to default, right? But this interest has to be paid. So what is the end game here? How does this not cause a slowdown in the economy? There's only two things that can happen. The debt has to come down. That's not going to happen, right? I know we have this Doge group, and they're going to cut a few billion here and there, but the level of our deficit is like 5 or 6% of GDP right now. That's not going to come down a lot, maybe a little. So the debt's going to keep growing, right? The other way is to lower the interest rate, right? That's the other variable. It's the debt times the interest rate. So the end game of this whole thing is that the Fed, and I think they all get it. I think Trump gets it, Bessent gets it, the Fed gets it, like rates have to be a lot lower. Right? At some point, that federal funds rate and the 10-year Treasury will be in the 2s. Right? It has to be. I mean, look at China. So China has 300% debt to GDP, like almost 3 times what we have. Their rates are in the 2s, and they've been cutting rates like crazy. Japan has 300% debt to GDP, again, almost 3 times ours. Their rates have been soaring over there all the way to 1.4%. Right? It's like they're keeping rates so low. I mean, the Bank of Canada slashing rates. Switzerland just cut rates the other day to 0.5%. Right? Europe is cutting rates. It's like the rest of the world kind of gets it and it's like, oh, we can't afford all this interest. And the U.S., again, is kind of pricing in these permanently high rates that don't make any sense to me, right? So I'm kind of a believer that at some point, I don't know if it's, I'm terrible at predicting what's going to happen in 3 to 6 months, but in 3 to 6 years, something will have to give. And I think the whole interest rate structure could be a little bit lower, which again is good. The problem is the reason it happens could be bad. It could be because something's blowing up and the stock market's down 40% and then the Fed has to cut rates a lot. And that could very well happen. If we're all lucky, they just kind of get the joke and they slowly cut rates and they get it back to 3% where they want it to be over the next couple of years. So let's hope that happens. One last thing. How are we doing on time? Wrap up in a few minutes? All right. So this is kind of the two things. One, this is what I call yield is destiny. This is like my bond sales pitch. Like I'm a bond guy, right? I do bonds, which is the foundation of your portfolio. And like stocks, you have no idea what's going to happen. Whether they're going to go up 30%, down 30%. Bitcoin, who knows? Currencies, who knows? Commodities, who knows? Right? It's kind of like a zero-sum game. But bonds, like 95% of the return is the coupon you get, is the yield you get, right? And they mean revert, meaning when you have a bad year, that means the rate went up. It means the next year you're going to have a better year, right? And they kind of bounce around. So look at this chart. So this is a major index that we all use. It's called the Bloomberg Aggregate Bond Index. It's every high-quality bond denominated in dollars in the world, right? And it was yielding, 40 years ago almost, 30-some-odd years ago, it was yielding 6 3/4. For the next 10 years, that index, which again is almost all government debt, it's a super high-quality index, and I know we manage money against this kind of index, it returns 7.5, so a little bit higher than your beginning yield, and that's because rates went down a little bit over that time. And you remember, this is the bond math part. Rates go down, bond prices go up, right? So that's kind of what happened. The next decade, same thing, right? You look at like the 2000s, well, I'll get that in a second. Same thing, the yield was 4 3/8, you got 5 1/4 a year for 10 years, and that's in a high-quality index. Our funds kind of beat that by like 1 to 2% a year, right? Because that's our goal is to beat that index. And then we had the lost decade in bonds. You started at 1 3/4, and you actually got a lower average annual return for 10 years, right? That's what I call looking in a rearview mirror. That's what just happened. That is not going to happen again, right? And your starting point today, this thing is yielding today, it's almost 5%. So what are bonds going to give you for the next 10 years? And I'd argue it's going to be 5 to 6 average per year. And that's in this real high quality index, and my job is to beat that, right? So that's really, really cool. The final thing I'll talk about is stocks versus bonds, right? And I know like there's this whole thing like, I don't know, I heard somebody in the lobby talking about standard deviation. I know you guys, like some of you guys were engineers, and so I can get into a little math here, but there's this correlation concept, right? And that's why Paul and his team call the bond part the foundation of your portfolio, and then you have the growth part. Like when the growth part is getting killed, and NVIDIA goes down 50%, and the NASDAQ goes down 30%, you want the bonds to kind of hang in there and offset it. You want that correlation to be negative so they balance each other, or at least zero. In 2022, a lot of people felt a lot of pain. I hope you didn't look at your statement. They don't look at their statements every year, right? Yeah, so stocks were down 30%, bonds were down 13%. And everybody's like, what the hell just happened? Where is that foundation part? You know, how did I lose so much money in bonds? Like, why did they both go down together? And it happens all the time, right? So I've studied the correlation of stocks and bonds for centuries. And on average, there is no correlation. They have no relationship on average, right? Everybody thinks they're negatively correlated, but they're not. On average, it's zero, right? So look at like 2000, so look at this chart. So right now, bonds are yielding, the black is the yield on the bond market. This is kind of the return you're going to get if you just buy an index, like 470. The yield on the stock market, you know, the PE on the stock market is like 23. So you just do the inverse of that and you get like you get 3 3/4 or something like that. So the stocks are yielding, the earnings yield is below the bond yield. Last time that happened was in 2000 during the dot-com bubble, right? For the next 10 years, bonds outperformed stocks for a decade. The 10 years after that, bonds did terribly, as you just saw, and stocks did great. So you've just had 2 decades where they moved in different directions, right, where they did offset each other a little bit. So over long periods, those correlations are kind of like zero, which is still really good. You just don't want them to move in the same direction. The one tenet, the one thing that is true through almost all historical periods is that in a recession, the correlations go negative. So meaning when stocks go down, your bond prices go up, right? The yields fall, so you get that balance, right? In a recession, especially a deep recession, because that is the environment where the Federal Reserve can take their 4.5% interest rate and say, I told you it was too high. Now we're in a recession, we're going to cut it not to 4, we're going to cut it to 2, right? And that is not priced in at all, meaning interest rates would fall a lot and the prices on your bonds could go up a fair amount. So if stocks are down 40% tomorrow, the Fed would probably cut 2% tomorrow and your bonds would go up 10%. Right, so it's not going to totally offset it, but they will be negatively correlated, and that's the kind of the part of the cycle you're in right now. So let me stop now. If you want to ask a few questions on like the Trump, I didn't get into his policy agenda, but I've got a lot of thoughts on that, or just about anything we talked about, or about your house price. I'm here. Yes, sir. So the price level is not going to come down, not likely. That big increase in prices in your insurance costs, your housing costs, your rent costs, your auto insurance, homeowners, I mean, those things are probably not going to come down a lot. They might, right? Believe it or not, global food prices went up like 70, 80% during the pandemic. From the peak almost 3 years ago, global food prices are down 25%. Okay, so once you get to these high levels, people change their behavior, right? And I think we're at this point in the cycle. You're looking at consumer behavior. I mean, Walmart and Amazon and Costco are gaining all the market share out there. Because people, even wealthy people, like I can't afford to go to, I go to Publix and they're like, they cost a fortune, right? It's like, let's go to Aldi's, and that's happening, man, all over the country and all over the world. You look at luxury sales in China are plummeting, right? It's like, we can't afford this stuff anymore. So behaviors changes and companies are competitive. They want to hold on to market share. So what do? Ultimately, they try to cut prices, right? So I think you may be surprised that these high price levels, maybe they stay where they are, but maybe they actually come down in certain areas, right? Trump would love to get oil prices and gas prices down, right? And maybe that happens, right? So don't be surprised if some of these prices stabilize or even come down. But you don't lose it forever, right? Because now you're printing a 6% coupon on your bonds. If you do that for 3 years, that's 20%. Right? And if inflation's running at 2 or 2.5, you're kind of making up 4%, right? Wages, you just saw, are growing at 3 3/4%. If inflation is at 2 or 2.5, wages are actually giving you more money than the price change, so you're going to grow into that price level. It's just taking a while. Sadly, I don't get wages. But you're getting a 6% coupon on your bonds that these guys have invested for you, right? And that adds up, man. Like I said, I own a lot of bonds, and 6% a year really adds up, and that's all I need. I care about wealth preservation, right? I mean, someone's got to give these kids money when I die, and because they're not going to sustain it. Yeah.
Interesting correlation between stocks and bonds. I like to.
So he was an engineer, right? You're one of the. Yeah.
Yes.
He's talking correlations. Yeah, here we go. All right, let's go.
So I'm just curious about metals like gold and silver and stuff. Is there any correlation anywhere in there between stocks, bonds, metals,
know,
etc.?
You know, that's a great one, like gold and silver and commodities and Bitcoin. I mean, to me, they're all the same. They're a way to invest in a hard asset, if you call crypto a hard asset, that's not a dollar, that's not a yen, that's not a fiat currency, that may protect you if the currencies crash, you know, which could happen, and they do all the time. So maybe there's a reason to own hard assets. I think real estate is kind of in that game. A lot of my personal portfolio is in residential real estate. I like having a piece of land in a nice place near the water that's not prone to a hurricane because you can live on it and you actually generate income, right? So I kind of think of it all kind of one asset class, right? Like non-current, non-stock, non-bond, you know, alternative kind of asset class that, and man, the correlations move around on those things. But I would bet if the stock market's down 50% and Nvidia's down 70% sometime next year, I'm going to bet Bitcoin's going to go down a lot, right? I think at certain points, and maybe gold will go down. I don't know. But at certain points, there's a correlation, right? And when you see them moving together, it makes me nervous that there's this kind of flight into those kind of assets. And maybe it's a little over. I mean, gold keeps hitting new highs, right? Crypto keeps hitting new highs. The stock market keeps hitting new highs. And I'm looking at that correlation saying, you know, who knows? Could the stock market crash and those things stay where they are? Maybe. But if the stock market crashes, people are like, I need some money, right? I should sell something. I'm not going to sell the stock. Let me sell my gold and Bitcoin because that hasn't moved, and then that comes down, right? So there tends to be this correlation over time. But in general, it's a great idea to have non-stocks and non-bonds in your portfolio. Maybe it's 5%, maybe it's 30%. I'm not sure where you guys are on that. Maybe some of it's real estate, right? I think that's always a good idea because it's not going to be 100% correlated, right? If the correlation is 0 over the long term, you want all that stuff, right? You'll have a much smoother return profile over time. But it's really hard to discern a specific relationship because so many factors determine, like gold is bought by a lot of central banks, right, who don't want to own the dollar. And it's also used in jewelry and some industrials, and silver's used in it. So it's really tough. Crypto is an odd one, right, because it only has one purpose, as a store of value. That's not a fiat currency. And I don't know. I'm not buying crypto. I should have. My son, who's in India, said, Daddy, I told you to buy crypto 3 years ago, you know. And so maybe he's a smart one. Yes, sir.
The current administration is using tariffs as a negotiation tool. Could you provide your perspective on what you feel the markets in general are viewing this tariff impact? Because it's a major point.
Yeah, this is a great one, right? I mean, the four main policies, you got the tariffs, you got the kind of the fiscal spending, you got the tax cuts, and you have the deregulation and the immigration policy, right? Some of them are good for the economy, some are bad. Deregulation is generally good, at least in the near term until you get a bubble. Cutting taxes is good in the near term until you have too much debt and the country blows up. Immigration, believe it or not, I mean, the labor supply in this country has surged so much in the last few years. I know here and where I am in Florida, I don't know how these economies would exist if we didn't have a lot of non-US born people doing all the work, right? And so if they went away, and I don't think that's going to happen, but if they did, I think you would have a big slowdown in the economy, not just from the production standpoint, but they're consumers, right? And a lot of them, believe it or not, are harder workers than a lot of Americans I know. But so the immigration thing, I think, is bad for growth, and I think it's bad for inflation because it's just less supply of labor. The tariff thing is bad for inflation, and it's actually bad for growth too, right? I mean, I know as like if you want to make America great again, you know, and you want to do better than other countries, maybe it works, maybe it helps a little bit, maybe it brings back jobs. But, you know, I was trained in, graduate school, took a lot of international economics courses. And, you know, there's this concept of comparative advantage. Again, not to get into, but the concept is really simple. If the U.S. is great at making computers, and we're good at making cars, right? And Mexico's terrible at making computers, but they're good at making cars. But they're actually worse at making cars than we are, but not by much. Like, we're a little bit better at making cars than Mexico, maybe, but we're a lot better at making computers. What you're supposed to do is the U.S. is supposed to make all the computers, and Mexico is supposed to make all the cars, right? Even though we're a little bit better at it. That is international trade like economics 101, right? Everybody is better off. Everybody's quality of life improves. So free trade, as an economist, as a trained economist, free trade is like this panacea. That's what we've all benefited from for the last 40, since World War II. We've benefited from this huge surge in global free trade. Now, a lot of it, manufacturing went to China, granted. Prices on everything we buy came down a lot, right? That's why those goods prices are like 0 or negative on average year over year. We love going to Walmart and buying cheap stuff, right? If that stops, it's painful. This price level that we're worried about, if that goes up again or jumps up, I mean, you could have a big slowdown in demand, right? And you could have a problem. That's where you could have this kind of recession risk kind of popping up all of a sudden. People are like, no, I can't afford this stuff already. And now you're going to raise the prices. So the good news is, again, Trump he's a mean reverting guy, right? He will change his policies if he has to. He uses them as a negotiating tactic, and he will go back and forth, and he just wants people to build stuff here. You know, when this happened in his last term, right, he saved like 1,000 jobs in the steel industry, right, because he tariffed steel. But like 70,000 jobs in the auto industry went away because they couldn't afford the steel. It's like, oh yeah, so you saved this one little industry, but you screwed the other ones. And that's kind of how tariffs work. Like as analysts, we have 140 bond analysts in my team, and they're looking at every single company trying to figure out, is it good for my company or is it bad for my company? And a lot of them are like, well, the autos, and a lot of people, and a lot of companies in this country, Boeing, they import parts from overseas all the time. And if they have to pay more, can they really pass it on through consumers? Maybe not, right? So the policies are very varied and different, and who knows what's going to happen. But I do take some solace in the fact that if things start going awry, the policies can change overnight. Trump is kind of great at flip-flopping. So one thing that happened last time, right? This is kind of, again, really important because it's what's happening on the margin. Small businesses, right? Small business optimism, which is the lifeblood of this country. Most of the jobs in this country are actually smaller businesses. They're not Prudential. They're not Boeing. They're Paul Reed. They're small, privately owned companies. Small business optimism surged in Trump 1.0. And it has just surged again. So if you ask small businesses, how optimistic are you on the economy? They're like, oh my God, this is much better. He's going to cut taxes. He's going to cut regulation, because regulation is really tough if you're a small company. You got to pay all these accounts. And so it surged. And then they say, are your capital investment, is it going to go up or down? And they're like, oh no, it's going to go down. And that's what happened last time, right? So you had this surge in optimism, but all the companies like, I have no idea what's going to happen with this tariff policy, so I'm not going to build a new plant in the US or in Mexico or in Canada or in China, because I have no idea what the impact's going to be, so I'm just going to wait and see. And that's exactly what's happening. If you look at these surveys now, the optimism's jumping, but if you say, are you going to invest more money and build new plants? They're like, no, I'm not going to build anything until I have more clarity. So we actually, that first Trump 1.0, you had all these policy risks, and the economy kind of started out good, rates went up, just like it has now, and then kind of things slowed a little bit, inflation came down, and rates fell for 3 years after that. And I feel like you're kind of setting up for that type of world, right? If you don't have certainty in terms of the policy, you do nothing, right? You're not going to build anything new. You're not going to start anything new. So I worry that maybe we have, and Trump said this the other day, we might go through some short-term pain, right? This could be part of the deal here to get what we want, and it could be pain that we as a country and him as a president aren't willing to take for more than a few months, right? If it becomes a problem, he'll reverse the policies. But it's really tough. I mean, Powell, the head of the central bank's like, I don't know what the hell's happened. I'm just going to sit on my hands until I have more clarity. And companies are doing the same thing.
2 more questions, Michael.
2 more. Wow, awesome. Yes, sir.
What are coins? How are they mined?
What are what?
What are coins like Bitcoin?
Okay.
How are they mined? Do they have any value? What are they backed by?
So the questions like Bitcoin, like what the hell is this thing? And I have no idea. That's why I don't own any. Yeah, I don't know what Yeah, so it's like a fake, currency, and well, the dollar is a fake currency, right? It's, Nixon back in the 70s said, we're not going to back it by gold anymore. That's why they call it a fiat currency. It's kind of, bogus. It's just back that, hey, we'll print more and we'll give you dollars if you want them, we'll make more. We have a printing press in Washington. And that's kind of what Bitcoin is, a little bit like that. But supposedly there's a limit on how much of this stuff they can make, because there is some technological limitations. But it uses a ton of electricity and a ton of energy to make these things, right? And so the whole theory is that there's a supply ceiling on how much Bitcoin can be made. So if there's more demand for Bitcoin and everybody starts buying it and they create these funds and ETFs of Bitcoin, and you have companies like MicroStrategy and all these like Blockbuster, the guy is buying Bitcoin now. All these companies are borrowing money now to buy Bitcoin as companies that have nothing to do with Bitcoin, because this one guy, Mike Saylor at MicroStrategy, did it and his stock valuation went to the moon. So they're like, let's do the same thing. Instead of making rental movies, instead of making, TVs, let's just borrow money and buy Bitcoin. What a great idea. I'm like, that sounds like a terrible idea, right? I mean, so I don't know, maybe it's a bubble, maybe it's not. I mean, if Bitcoin crashes again, you're going to have a bunch of companies going bankrupt, right, that are relying on it to do well. And that's how bubbles form. Everybody kind of buys into this notion that it's going to keep going up because it has done well. And that's when the red flags go up for me, right, that it's like too many people are involved in it. But heck, if it's 1% of your portfolio, I don't know if you guys do any crypto, and yeah, if it's 1% of your portfolio, why not, It's fun, if you lose it all, who cares? Yeah, it's 1%. One more question. No more questions. All right, great. Thank you guys so much.
Thank you, Michael.
Thank you.
Excellent.
Thank you.
Hey, what do you think? Enjoy it? Insightful? The nice part about Michael is number one, he's one of the managers in almost all of your portfolios. And number two, he's got a deep knowledge, as you can understand, about the fixed income market, the foundation area, and also a good sense for kind of what we're all about, which is make sure you protect your portfolio, grow it consistently, not deviate too much from the asset allocation that we have. And one of the things that Michael talked about, we've talked about behavioral finance before, and that's the influence of your emotions on your investments. So again, I thought you addressed that very well. As I think about any classes that we might take, remember in your Boeing days, or any classes that I teach or Tim's involved in, I always like to leave you with some takeaways. So I'm going to give you 4 takeaways for our time together today. Then we're going to have some fun. First, the takeaways. Number one, markets always go in cycles. Every 5.5 years, history says markets will go down by 20% or more. Every 3.5 years, markets go down by 15%. Now, think how 2023 was, how 2024 was, which is good. What does that tell you about 25 and 26? Be prepared for volatility. But as our speaker indicated so clearly, don't let that disrupt you from your overall investment strategy. Now, I don't want to talk to the choir because you all know that, but just recognize it would not surprise us if something happened. And I like the idea of, hey, I listed 10 of the things that I fear most about what's going to happen in the market, and none of those 10 things happen because it's something that will probably come out of the clear blue. Who could have expected the pandemic? Who could have expected 2022? Who could have expected a global recession? So number one, markets go in cycles. And a couple of quotes I think are really important. These are from noted investment managers that support that point number one. One quote, and I believe Mark Twain said this, but it simply says, history doesn't repeat itself, but it strangely rhymes. Second of all, the 4 most damaging words in the investment community for an investor is, this time is different. So the media would have you say and have you believe it is different. I'm suggesting that we've been through this before, just in a different arena. Second takeaway, don't let politics or economics drive your investment decision. You see, we've tracked investment performance since 1968. And interestingly enough, there's a lot of presidential cycles. What happens 1 year into a presidential term, then it's 2 years, then the 3rd year, then the 4th year. Let me suggest this to you. History says that roughly 80% of the time, the markets are higher at the end of the first term of a presidential election than at the beginning. Does that mean it's going to happen again? Of course, we don't know. But statistics is on our side. And when we think about economists, not to have them drive your investment decisions, another quote came to mind. Another noted investment manager said this about economists. With all due respect, by the way, Michael, Economists make fortune tellers look respectable. I won't say any more. Takeaway number 3. Markets are very efficient and they're forward-looking, and they tend to price in events. I think that was kind of brought up. Some have said, boy, isn't it great the first few weeks of the year? It's been great. It is great. But remember, they're forward-looking. They price in events. And of course, a discipline plan is your best chance for success. Also, our speaker referred to fear of missing out, fear of loss. Oh, darn it, I missed out on what happened last year. Well, guess what? What happened last year might be a thing that happens the worst this year. So let me give you 2 principles to support that. Principle number 1, and this is a quote as well. Markets are very, I believe this was Warren Buffett, by the way. Markets are very efficient at rewarding the patient at the expense of the impatient. Think about that. And of course, this is one that Tim and I and Adam and Kelly and Georgianne have all preached to you. It is time in the market, not timing of the market, that makes most important. See, too often what happens is we think our emotions tell us we got to get out of the market because this has happened politically or this has happened economically. I'm suggesting that we want to pay attention to what happens in those arenas. But I'm suggesting that the breakdown happens when we say, therefore, this is happening, therefore I need to change my investments this way. So no problem with being informed, but leave that portfolio up to us. And if you're concerned, by the way, I'll say this too, because no one knows what's going to happen in the next 3 months, 6 months, or a year ahead. I want to emphasize this, we're here for you. So if there's any concern whatsoever between our meetings, don't hesitate to reach out to us. I mean, we have meetings for most of you once every 6 months. Many are virtual, some are by phone meetings. We've got the portal, we've got the client education events coming up, and we have had them. But remember this, we're here as a team to support you. And not knowing what's ahead, we don't know when that might test your risk temperament. So just realize we're here. So number 1, number 2, number 3, let's talk about number 4. Principle number 4, takeaway. And it simply is this, is we're dedicated and prepared and completely focused on your success. And I'll tell you a couple things about that. Number 1 is your financial team is prepared. You know, we draw from 3 decades of experience. Some of you have been around with us for 3 decades. But the portfolios that you have today are an outgrowth of our experience during Black Monday, remember 1987, Y2K, 9/11, the Great Recession, 2007, 2008, 9, and of course, we just had the global pandemic. So just realize that your portfolio is not just a cookie cutter approach, that this is the great manager, it's what we do. No, that's part of what Adam does and the investment team over there to be able to curate that. And yes, we rely on a ton of statistics and great managers like PGIM, but remember, they're working for us, just like we're working for you. So our entire compensation, just as a reminder, comes from you. We have no vested interest in the managers that we use except for your success, period. You know, the other thing I would say is besides your team is prepared, once again, your portfolio is prepared. And Tim and I and others are often say this, and it's simply as a quote. I don't know if we said it or someone else said it, I have no idea, but the quote I want to give you is your portfolio is built for times like this. I think that's really important. Many of you have come to us when you first retired, and your main objective before you retired was principal growth. And when you look at your 401k statement, it looks great when it's up here and not down here the month. But once you retire, remember those long number charts? You all done those long number charts, how long money will last? Remember we've done all those? Remember it kind of goes like this. And guess what? That is designed to give you a sense of confidence, no guarantees of the future. But that's also designed to let you know that the process we go through is designed for your portfolio to have consistent returns over a variety of market conditions with the goal of, number 1, preservation of capital, number 2, an inflation-hedged income to add to your pensions and Social Security, and number 3, growth. because some of you are in a position where you might want to pass that on to your kids, so we're certainly supporting that too. Well, 4 takeaways. Once again, markets go in cycles. Number 2, don't let politics or economics drive your investment decisions. Number 3, markets are very efficient. And number 4, we're dedicated and prepared with a portfolio and a team that's designed to all be focused on your success. But let me wrap up with kind of one of the best ways to end a session like this. And it's quotes from 3 noted, very successful investment managers of years gone by, currently 2. Warren Buffett, Peter Lynch, member of Fidelity fame, John Templeton. So when they're asked about, hey, talk about investment management, there's important quotes that each of them said. I'm going to pick one quote from each of them because I think it best represents what we're trying to convey today and what this is all about, and why we're here. First of all, this is Warren Buffett. Of course, very influential and successful money manager. We know his style, and I think you're going to relate to this quote. What he said is, we don't have, never have had, and never will have an opinion about where the stock market, interest rates, or business activity will be a year from now. And that has always been our opinion. So Warren Buffett says, as you know, buy good companies, hold for the long term, look at some of the fundamentals, and make strategic changes as appropriate. Peter Lynch, many years ago, manager who was a growth manager, invested in a lot of growth companies. I remember some stories about Peter Lynch walking into a store and anecdotally looking at, gee, I got to buy this stock because the traffic looks so good, but a very good feeling about the companies. What Peter Lynch said is this: I have no feeling for the direction of the market over the near term or the next 3 to 12 months. Doesn't know. And I think John Templeton said it best. John Templeton, well known for being an international and global investment manager. And I think he kind of summarized those two and summarized really the takeaway we'd love to have you hold on to from this event. What John Templeton said: ignore fluctuations, do not try to outguess the market, buy a quality portfolio, and invest for the long term.